Okay, what's up, YouTube family? How y'all doing today? We coming back, checking in, Try to post a little streaming videos. I don't know if anybody watched the stream video. They were just talking about dividends. And I was on stream talking about it, just doing some studying, I would say. Definitely doing the studying. But today, I definitely want to come and talk to y'all, like, see if y'all been on track. Have anybody been putting that 10% up, saving their money, trying to start an emergency fund so you can eventually make your way to investing? Even did you all, like, open up a Roth IRA? But we don't want, like I said, I don't want to make the task too hard on y'all. So start where you can, and the best way to start is trying to save some money. Put it in a high yield savings account. At least you got that emergency fund, because if something happened in your life, that's something that you're definitely going to need. So the Roth IRA, after saving up for that emergency fund, like I said, something gonna come up. Whatever could go wrong, gonna go wrong. So save up for that first. Then for those that's like got a job, you don't gotta worry about the Roth IRA. But if you want to do the little extra, you can do the Roth IRA, and you got main control, complete control over that Roth IRA versus a job. You don't know what's really going on with that investment. So today, what I wanted to come and talk to y'all about, like, what kind of investor are we? Because I know as beginners right now, I'm a little past beginner, but I'm still learning. I'm gonna always be learning. But I know for sure, long term is the best way. And for beginners, because I've been telling y'all about SPY, VOO, all this on index funds, because that's an easy way. Those ETFs, you could put it, forget it. Like they say, set it, forget it. Let it keep on growing, get that 8, 10%. Sometimes that bad boy be up to what, 12, 20%. The last couple of years, I think it was 20% growth. So that's more stuff you could put your money in and just let it grow. And that's more long term, because when you put your money in, you're expecting to leave your money there for at least 30 years. Or you can leave it there all the way to retirement. That money will definitely grow for you. Like, but long term investing is not a get rich quick scheme at all. That is not the way for you if you're trying to get money fast. But just know, if you're trying to get money fast, getting money fast ain't easy. It's going to take some skills. But we definitely going to go over that in this next section. But long term investing, this the main things. But with long term investing, the main thing it takes is consistency. You can start, but you have to finish the job. So for the rest of your life, like I said, if you really want to be somewhere, mind you, something is better than nothing. I understand that. But we want to have a nice, decent amount. So once we retire, we can live off that amount. Even if we ain't got to live off that amount, it could continue to grow. But we could pull our money out, do whatever we want to, buy a house, whatever it is like that you want to do with your money. But this is a way you could definitely put your money to work for you, and you not just keep going to work for your money. So that's the whole purpose of it, where we can make money in our sleep. But long term investing, all it requires is main thing consistency. Because you can invest in S&P 500, even though even long term investors diversify from S&P 500 to other index funds like tech stocks, QQQ, stuff like that. That could definitely be a way you can long term invest. Some long term investors also invest into, say, Apple or Nvidia, just the stock alone. But most beginner friendly way is ETF, exchange traded fund, which is like 500 overall best stocks that's in the US, and it will invest that money for you, and it will continue to go up. Now, mind you, like I said, it will dip, but it goes like that. Dip goes like that. But the S&P 500, by being 500 stocks, it dips. But an individual stock, you will see a lot more. It like, you know what I'm saying, gonna dip down a lot more because it's only one company. Versus that 500 is way more stable, so it's gonna just, those dips don't be as much sharp. It's more of a like a loop, and it comes up. So the main thing I say is consistency. So if you're gonna choose $20 a month or $20 a week, invest that $20, and don't just put it in your brokerage account. Put it in the stock. Like if you got Vanguard, Charles Schwab, they have their own S&P 500 that tracks the index. So you could put $20, you could put $5, you could put however much you want to. But I say just go in weekly. Once that money hit, you'll realize where did that money hit, and go and invest it. Go and invest it. Go and invest it. And that's a thing called like dollar cost averaging. You're gonna keep putting money in no matter what's going on in the market. You ain't gotta do no research what's going on in the market. If stocks down, if they up, no matter what, we're gonna continue to invest in it. So over time, long haul, the money's gonna continue to grow. But if you can, I'll say this: that 520, 500 a week, whatever we doing, we can keep that consistently. But if you do have extra money in the account, you ain't gotta invest all of it, like 800 this week, 500 this week, 1,000 this week. No, You could keep staying with your 500, and whatever extra you got in that account, let that continue to build up. So when the time comes and you do happen to look in the market and be like, oh dang, S&P 500 is down 30%. Guess what? We got an extra $1,000 right there. So we could take the extra 1,000, slap it on top, because now we got a way lower cost basis because this is down. We is not buying in the middle or at the top. We is way down. Even if it drops a little bit more, it don't matter because we can never time the market. But that's why we is dollar cost averaging, because time inside of the market beats timing the market. Because if you're trying to time the market, you will never invest. And a lot of people try to do that, wait for the bottom, but the bottom is never the bottom. If we had them, if we had the psychic skills to know the bottom, guess what? We'll all be rich. We can wait till it go to the bottom, throw all our money in. Keep waiting till it go to the bottom, throw all our money in. But at the end of the day, time in the market beats time in the market because your money is growing over time. You can't just keep waiting every 6 months when they hit the bottom and throw more money in. So y'all keep that in mind. That's definitely long-term investing. And I recommend ETFs and mutual funds for beginners. That way you ain't got to go look through certain stocks, wondering what's going on. Like I told everybody, for the individual stocks, 52-week high, 52-week low, you got to know that. That's whether if it's at a high or a low and you putting your money in. But stay consistent. That's the main thing you want you all to do, is stay consistent. And don't forget, I said sit it and forget it. A lot of beginners, I ain't gonna say beginners, a lot of experienced people as well that's not really experienced. They just been doing it a long time, but they really don't got the time in, the skin in the game. Because they'll keep checking the stocks, and when it's down, oh, I need to take my money out. If it's an ETF, SP 500 like that, you do not have to take your money out. The market will recover. Like I said, unless it's a crisis, the end of the world, then we ain't gonna be using none of the money anyway, because we all gonna be trying to find and scavenge whatever we could get. But do not keep checking it. Don't put your money out. The purpose of it, 10, 30 years or more, keep compound growing it. Let the money work for you and stack up on top of itself. All right, y'all. So this is the second one, is trading, which I've definitely looked into trading. It definitely is a skill. Like, it's kind of like you a hustler. You graduated from the beginner to a hustler. You're trying to get it, right? So traders, they got day traders, they got swing traders, they got options traders that trade leaps and stuff like that. So it definitely take a bit of skill, but I'll say take your time and learn about it. We're gonna definitely go over all that in this channel, but we want to get y'all started. The main thing I want is get y'all started, putting money in the market, letting it work for you. Because if you don't get started, you will never make your way to trading options, none of that. So first time is long term. I believe everybody should be a long term investor, putting some in some ETFs and some stocks to grow long term. Because once you become a trader, what I do is, if I win a trade, I take 50% of the wins. If I win 100, take $50, put it into long term. Take $100, put it into long term. But you still keeping some of that in the trading account so you can continue to trade. But the whole purpose of that is, like, say you go to the casino, win 500, I'm going to take out 400 because I only went to the casino with $100. So that means the casino will never ever again in this life see my 400 that I won from the casino. I'm only willing to lose that $100 that I've been keep on playing with at the casino. And that's where a lot of people mess up at. They win 500, but then they go back and play 500, and guess what? The casino gonna take the money right back, and now you got to come with a new $100 bill, and that's what we don't want to do. We could keep playing off the same thing, same $100, and a lot of people call it this in the market. So we put 100 in, we win 500, right? So we could take our 100 out plus an extra 300. So that last 100 is you playing with the market money. That's the market money that it really gave you, but now you got profit to take that out and keep on playing with that same 100. So it's really considered free money because the $100 you put in, you been took it out. You still playing with the $100 that you won previously. And the main way how trading work with options, swing trading, no matter what, you're looking at the candlestick patterns, you're looking at the chart. That's why it takes more skill. You got to read the chart, stock analysis, all this technical analysis, and you're looking at the chart when it's going up. Is the bears winning the fight, which bears is going down? If the bulls winning the fight, which people are buying and going up. So that's the main things you gotta look at, and you trade price action. So if a stock is at $50 and you say, you know what, this stock was just at $150, so I'm going to put in a trade to say this stock is definitely going to $60, which you will be choosing the strike price and expiration date to say this stock going to go at $60 by January 5th. And once that stock do go up, you do make a lot more money, but it is risky. You got to have the skills to do this and know your risk tolerance. So it takes a lot more advanced trader or individual to know what they're doing. Because if you're a beginner and you don't know what you're doing, you could do like I did and trade at an all-time high. That's when you really got to pay attention to if a stock is at all-time high, all-time low. Because you trade at an all-time high and the stock just happened to dip back down, this is something you should know. So that's why I say it takes a lot more advanced. And you go off of like the news, like right now, Donald Trump, your president, the president, he would say anything and the stock gonna move. The trade with the war, oh this we ended this, so the stock is gonna run up. But if they say, oh no, we still ain't come to peace with the war, the stock is going right back down. So people that know what they're doing and they seeing these things going on, you could trade those price actions. You can look at the stock or bad news, I already know something about to happen. This about to come down, so let's watch it. And the minute it hit here, let's get in so it ride down. Stuff like that. But keep in mind, you could lose a lot of money trading. So please do your research. Like I said, I'm not a financial guru. This is my journey that I'm going on, that I'm constantly learning. And trading is one of the things I've been in. And I've definitely lost a little bit. Never a lot. Because I learned from the small things. You don't jump in big. You jump in small, build that tolerance. And they also got some people that just trade the stock, which is safer than an option trade, right? Trading the stock is, I just bought VOO, for example. I'm going to hold it till it go from 450 to 500, which you don't never have to sell it, but you sell it when it hit 500. Option trading, you got an expiration date, you got a time limit, versus buying and holding it and trade it when it hit a certain point. That's an easier way to make money, but you don't know exactly when it's going to hit that point. But that is a way more safer route that you all can definitely look at, and just trading stocks in general. You buy Nvidia at 100, okay, it's at 200 now. Let me go ahead and sell my Nvidia. So you might have got your $1,000 profit, but the bad thing about trading the stocks in general for me, like good companies that I want to hold for a long term, is I trade Nvidia right now. I'll get okay $1,500, $2,000 off my trade. But when it's time to buy back in, the stock is up to 200 now. So we gotta start back over. And versus if I leave the money in there, let it keep on building up, and dollar cost average once it pull back. So if at 200 it pull back to 180, okay, I could buy another one, let it do its thing. As it pull back to 190, buy some more. You know what I'm saying? We just keep on leveraging that, y'all. Keep on pushing, keep on pushing. Like I said, consistency is the main thing. And this video we did with, like, I was streaming it though, dividend investors, because we got dividend investors, and I've been trying to learn definitely more about dividend investing, which I've been having SCHD, which is a ETF full of dividend stocks like Home Depot, probably McDonald's, Costco, different companies like that, that is paying dividends, and like it's big cash cows, big companies that's just paying out their investors. And it's quarterly with SCHD. But you ain't gotta look at SCHD in general. I went over in a dividend video. They got like closed-end funds that's probably paying monthly, not quarterly. But this is something that you do when you're looking for like passive income. So my understanding of it, like I said, I'm still doing research. My understanding of it is you putting money into a dividend fund with the drip on, like I said, dividends reinvested. So you buy one share, you got dividends on. So say, for example, that one share is $1. Your dividends is 50 cents. So by the time you put drip on, and you getting paid 4 times if you're paying quarterly, so you getting $2, 50 cents times the 4, that's $2. So by the end of that year, it will bought you 2 more shares. It'll been bought you 2 more shares, because those $2, which is $1 each per share. And as you continue to do that, you're keep on letting dividends buy, but you're also putting money into that fund to where it's going to stack up on top of each other. So a lot of people call it the snowball method, like pushing the snowball down the hill. And as it builds up, the snowball becomes bigger, because your dividends just keep buying you more shares. So the more shares you have, the more dividends you're going to get, which is going to accumulate to more shares. So it's more like a passive investing. Like you don't got to do much. The dividend's still going to be working for you in the background. You can still invest consistently, which is definitely recommended. But the dividend whole purpose is for the dividends to build up and eventually take over your expenses. Because I know a lot of people, they purpose with dividends investing, once they retire, for example, you spend $50,000 a year, but the goal is to be getting $50,000 or even more in dividends. So once I cash out my dividends, My dividends is paying my bills, but I still got this money in the market. It seems like a stretch in the beginning, like they were saying, for in order to get $30,000 or something like that, $1,000, you gotta have $30,000 invested. But with dividends, if we starting early, we don't have to have the 30,000 invested if we started early and let the drip continue to do its thing, let that snowball get bigger. But if you just starting out and like say at retirement, I want to get this dividends, yeah, you probably got to put $1.5 million in the market because you no longer have time for it to snowball. It's no longer a snowball effect. You automatically starting just like that, flicking the switch on. All right, y'all, and I think this, well, a lot of us want to be at. I know everybody is safer for everybody to be a long-term investor, but this one is a hybrid investor where you invest in mainly long-term, 70%, let's say for example, 70% long-term investments. Okay, cool. We being consistent. And then we got 10-20% in the dividend fund. Like I said, we got the snowball, we got the drip, everything rolling over for us. But we also got maybe 5-10% in trading options, because options is a way you could definitely build some capital. Like I was saying, you building capital, take 50%, put in long term, take the 50%, put in a dividend. So your main income is like not the main. I'm gonna say your side hustle is trading options, but you're taking some half of that money from options and putting to the long term or dividend investing. That way you got a full diversification portfolio. Because you got the long terms, you got your VOO, which we talk about SP 500. You got some basic regular stocks, long term growth stocks. Plus we got good dividend stocks that's gonna push our income even further. So I think most people, this is where you want to be. But like I said, I'm not a financial guru, not a financial advisor. So do your own research. But the hybrid investor, it got a nice little piece of the pie because it kind of touch all around the board. So like I was saying, I definitely prefer the hybrid investor. We got it all around the board. We touching everything, all our eggs not in one basket. So I want to let you all know, don't go the bad route trying to get the quick money. The quick money don't be good. You got to start simple, because if you're trying to get the quick money and you don't have the skill, guess what? You're going to lose money fast. And that's one thing we don't want to do, is lose money fast. So start off strong. S&P 500, that's your foundation. Before you invest in actual stocks, foundation is S&P 500. Because if your foundation ain't right, what they always say, it's like a house of cards. One little bump is all coming down. So make sure your foundation strong. You don't want it strong at the top, because that's going to break your whole structure. And overall, you got to stay consistent. That's one of the main things. Overall, you want a strong foundation, but that without consistency, that foundation is going to be what it is. In order to build up to make it a strong foundation, we got to stay consistent. So, all right, y'all. So hopefully y'all learned something from the video, and I just want to tell y'all, just get started. You got to get started. You don't got to master everything. You ain't got to know exactly everything what to do. But as the time goes by, you eventually get little eggs here, little knowledge here, little knowledge here. Because it don't take a lot of education to do the long-term investing. You could pick one thing. So choose your thing that you know, understand it. What Warren Buffett was like, you invest in your circle of competence. What you know, you can stay within that. You ain't got to do crypto, and you ain't got to do everything else people telling you to do. It's your journey. Like you said, we running our own race at our own pace. So don't go off what they're doing for their lifestyle, because you know why? They might be getting $1 million they can invest. They might could lose 100,000, but you can't afford to lose 100,000. If you can only afford to lose 1,000, you cannot play with $1 millionaire mindset. You see what I'm saying? You can play with the mindset, but don't take the bad parts of it and think you could take the same risk as a millionaire. No, you cannot do that. So stay in the game long enough to eventually our money grow for us, and at the end of the day, we all winning, baby. That's all I'm saying. We all win at the end of the day. So hybrid investor, y'all definitely look more into it, because that's a little bit of all the things that we mentioned. But just starting out, beginner friendly, long-term investing is the way to go. VOO, SPY, SWPPX, whichever brokerage you with, definitely do your research and see what is their index fund that is tracking the S&P 500. Because every brokerage most likely have their own index fund or a mutual fund that's tracked to S&P 500. So until then, just checking in with y'all. Hopefully everybody been on a good path, good journey, and hopefully see you all at the top. But you know what I'm saying? We got to keep on growing. So, and that's why I'm documenting these videos, because I'm doing the same thing. I got the $50, whatever, going in weekly, and you're doing a dollar cost averaging. And you would spread it across the board, not just right here. So we growing it slowly, baby. And our foundation gonna be strong. So y'all stay tuned. This your boy Jay in the building. And keep following the journey. And we will continue on this race till the end. Salute.